Let's jump off with one of the biggest companies in the world, a favorite of the Australian Investors podcast, one that I own and I believe you own, which is Apple. Trades under the ticker symbol AAPL. Tell us a little bit about this, mate. Let's start the timer for 5 minutes.
All right. Okay. So Apple, it makes Apple computers, it makes Macs, it makes iPads, it makes iPhones, it makes Apple Watches, it sells services, most likely if you're listening, you're probably listening to it on an Apple podcast. If you're doing that, that's great. We love you for that. So what did it do? What did it do? Earnings per share was only $2.10 versus, the expectation was 189 or something like that. It was up 25% year over year. Okay. This is a small little company that's only growing its revenue at 25% per year. Earnings per share at 25% per year. Revenue was $124 billion. 124 billion. It significantly beat its estimates, up only 11% year over year. How does that happen? That your revenue grows 11% and your EPS grows 25%. Well, some of that is operating leverage. Some of that is share buyback. Gross margin went up. That is very, very interesting in an environment where things are more costly. I would have thought gross margins would actually compress. Gross margins went up. They were very high, 43.8%. A couple of things I'll point out very quickly. Installed base of Apple devices is 1.8 billion, 1.8 billion, not million, 1.8 billion. Growth was pretty broad-based across all categories. Another number I like to quote, people forget this, but as Apple is a services business too, they had 789 million paid subscriptions on their platform. That's up 165 million in just last 12 months. That is just unbelievable. Services gross margin was 72.4%. What is really interesting is just 3 years back, the services gross margin was 62.8%, right? So that is a phenomenal leverage that is showing through in that business. Services is now a north of $70 billion annual run rate business, growing about like 24%. That is the size of Fortune 50 company. Fantastic business. One of the things to watch is Apple doesn't spend a lot on R&D compared to some of the other companies. Does not spend a lot on CapEx as well.
So your tweet about this.
Yeah. Think about the efficiency of this business. It can generate the largest amount of revenue possible through very careful spending of money. I love that. I'll give this a grade A+, and I think I did it under time.
Oh, you did it very under time. I think, well, let's just talk about it. Apple is one of the big tech stocks, one of the FANG stocks that's just powered ahead. We've seen some of the businesses falter. One of them we'll talk about in just a minute. But it's been impressive. And you know what I think is really impressive? We didn't really get to it there, but the Chinese segment, the Chinese business is actually growing incredibly well. Whereas a few years ago, there was a lot of tension, obviously, when Donald Trump was president, and trying to get product in and out of China and privacy and source code, all that sort of stuff. But now it's taking off, and it's still seen as the premier brand in China, which is a massive market that it's not untapped, but it's a huge, huge growth market for the business over the next decade. So not just on the hardware side, but also on the services side. So I'd agree with you. I own shares. We're in the presence of another bull here. So we're both pretty keen on this business, and we both have owned it for a while. So A+ for Apple, I like it.